Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and today we're going to have our weekly strategy roundtable. Good morning, Joseph. Thank you for joining. Ian, welcome back. Today we're going to have our weekly strategy roundtable where we talk about current market conditions, next move in the market, what to expect short-term and long-term. Disclosures are very important. If this is your first time seeing the disclosures, it's very important to pause the screen and visit the link on your screen, optionsclearing.com, so you can understand the risk associated with trading stock and options and the suitability. And you can pause the screen to see the remaining of the disclosures. Trading psychology is important, right? The idea is to have a trading plan and follow the trading plan. But before we get into a trading plan, let's talk about current market conditions and what to expect. Q1, let's talk about February, March, and beyond. So spiders maybe made the marginal new highs, right? Slightly higher. We have a new 611, almost 611, 610.99. Okay, so I think we have basically retest of 2025 highs, January highs, February retest. And very important level, right? In terms of positioning, this is extremely important level, right? 610. The next level in terms of positioning would be 620. And on the downside, 600, right? We've been trading, let's be more conservative, let's do 590, right? So 590. So this rectangle or box pattern basically been continuing, for the most part of 2025. So on the downside, we have a support of 590. Give me 1 second. Sorry, just give me 1 second. All right, sorry about that. So spiders is trading in the box between 610 and 590. And what is the next move, right? I mean, I would say 70% of the time market pulls back, right? And 30% of the time the market breaks out. But you need positive catalysts. Maybe because the tariffs, the reciprocal tariffs got delayed. That could be a catalyst, right, for the market to break to the upside. It could be next week we have VIX expiration and spiders expiration, right? A lot of institutions going to reposition, and based on their view on the market and based on the macroeconomic data and tariff data, we could break to the upside or to the downside. But usually, the way I look at it, trade what you see, not what you think, right? And what I see is kind of a triple top, and until there is a confirmed breakout, you assume that the market is overbought and probably will pull back. So this is a time to potentially maybe start thinking about raising cash. But trading, think of trading is basically as the distribution of possible outcomes, right? So if I look at the spiders gamma exposure, right, and going back to game theory, right? It's not really important what I think. What important is what does other people think. And you can clearly see that right now, after the 610 strike, right? Assuming we're going to break out the 610, the next strike is 615 and 620. There's already a lot of positioning, especially in 620 level. So if we can reach that escape velocity and break through the 610, if today we close above 610, Monday we close above 610, and Tuesday, I would say then probably, after 2 to 3 days staying above 610 level, you can assume that this breakout has more room to the upside, especially as we reach end of February going into March. I mean, we still have to figure out the tariff situation, NVIDIA earnings, but the next logical level is 620. And in terms of distribution of possible outcomes, let's look at February expiration and March expiration, right? Well, actually, February is not that important because it's next week. Let's look at March and April now. So if I look at the March and April, the distribution of possible outcomes is that somewhere between 625 and 630, right? That's the one standard deviation to the upside. If all the stars align, then 70% of the time, we're probably going to be somewhere between 625 and 630 by end of Q1, right? Going into April and next earnings season. On the downside, right? And you can see no positioning. mean, very little gamma to the downside, but you do have some positioning at 600. But revisit, that level 590, 595. So positive news, we're at 630. Negative news, we're at 590. Combination of positive negative news, we're trading sideways somewhere between 600 and 610 level, right? So that's how you would look at the market. You could have an opinion, right? You can say that, okay, Trump is pro-business, and no matter what he's going to do, taxes are low, regulations are lower, and he's going to find the agreement with European Union, Americas and China, and market is just going to continue to go higher. Okay, if that's your perspective, then fine. But by end of March, April, maybe we can get at 630 level. On the downside, 590 and 595 level. So think about it as just going back to your high school statistics, right? Just distribution of possible outcomes, right? And you basically say, well, most of the time the stock market is going to spend time here, right? Right, but one standard deviation could move to 625, 630. Two standard deviation if Trump next week is able to reach an agreement between Russia, Ukraine, and China, and get Russia back into the global 7 largest economies of the world. Okay, great. Then market is going to move to standard deviation, right? The war is over. Everybody's going to be happy. The prices of commodities going to start going lower, and and that would be one of those outliers, positive outliers, right? Where we could receive 630. The negative outlier would be 60% tariffs on China because he can't reach an agreement with Russia and Ukraine, right? And then we're at 590, 595. So that's what most people think, right? In terms of gamma, you can see right now the largest gamma is at 620 strike, right? So the bias is to the upside. The bias is to the upside. That doesn't mean it's going to go there, but that's what most people are thinking. Hedging, selling their calls at 620 level, right? And the dealers will have to buy these strikes. Any question? Right, and now you go through this positive and negative rehearsal exercises, right? So, okay, let's go back to our statistics class, right? So let's call 620 as maybe 1 sigma move, right? And then 590 is gonna be your 1 sigma move, right? And then 2 sigma move is, let's say we revisit November lows. Well, I think that's too much. 580. Tough. Let's do 580. So 2 sigma we revisit in 2025 lows, 580, 575. And on the upside, maybe 630, right? 635, right? 2 sigma, right? And it's a bell-shaped distribution curve, right? Okay. So how many of you think we're gonna move? So one case scenario is that between now and start of the next earnings season, right? We're going to be break through the new highs. This is a confirmed breakout, and we're going to trade above 620, right? 635. That's one standard deviation. 2 standard deviation move. One standard deviation, 70% of the time, we're going to spend time between 620 and 590, right? That's scenario number 2. Because for every positive news, there is always a negative news, right? At least that's how it's been in the past couple months. And we're trading between 620 and 590 range. And the third scenario, 2 standard deviation move to the downside. Say Trump cannot reach an agreement with Russia and China, and he starts imposing 60% tariffs on China, and tightening the screws on Russia economy. Okay, then that would be probably 2 standard deviation move to the downside. And why is this exercise important? Again, position sizing, because if you're bullish or you're market neutral or you're bearish, you need to determine, well, what percentage of my portfolio can I risk to support my opinion on the market, right? So this future rehearsal exercise, you do it in the corporate world, right? A lot of CEOs, CTOs doing, you do it in the business, in the sports, right? Bulls before, or Bears, Chicago Bears, before they go out, they have going through these plays and they go positive, negative. if this guy does this, then I do this. So this is very important exercise, and trading is the same way. I mean, you need to look at the positives. The way we wired, the brain is wired, we usually try to shield our brain from negative, right? A lot of people actually ask me, like, Vlad, why do you think market is going to sell off? You're too negative. I'm not negative nor positive. I just want to go through both scenarios to determine what size should I take, right? It's not only important to predict what the market will do, but also how you will react to market pullback, right? So those are important questions to determine. This is important exercise, whether you're a day trader and you're just thinking about minutes or hours. If you're a aggressive short-term trader and you think about a couple days, maybe a week, or if you're momentum or swing trader, you're thinking about weeks, months. In all scenarios, whatever the time frame for your trading, this is important exercise that can help you determine the position size. And also prepare you that if the market moves against you, you know what you're gonna do if the market reaches 600, and you have a plan to know what you need to do when the market reaches 580. Right? You're not gonna be caught by surprise. And I encourage you to write that down in a journal and keep a journal where you would write down the levels. The buy signal. Why did you get into the trade? Right? Maybe it's a paid program, and Keith told you. So that's not told you, but a signal was generated, right? Signal was generated, and you decided, okay, this is a great paid program. I'm going to take the signal, and I'm going to, but then the question is the size, right? Is it 1 contract, 2, 5 contracts? I can't answer that question. Keith cannot answer that question. But, we can walk you through this rehearsal exercise to determine, if the trade goes in your favor or against you, how much money are you willing to risk? So that's why this exercise is extremely important, right? So, in this example, let's say you're bullish and you think it's going to go to 630, right? Like, if you're a short-term trader, you're thinking about a couple of days and weeks, maybe 590, 600 or 590 is your support. A couple of days is 600, couple, weeks is 590, right? A couple of months, it's 580, right? Just depends how long, on average, how long you like to hold the position. So, and then at each of these levels, you need to determine how many shares you're willing to buy, right? So if you enter in the market at 610, but you want to exit 600, then it's 10 points, right? Your stop loss, right? If you're thinking about a couple of days. If you're thinking about a couple of weeks, then this is a 20 points, right? You're risking 20 points as your stop level. And, if you like to think about, a lot of people say, well, I only exit if it reaches 200-day moving average. Okay, great. Then it's 580, right? So 10 points, 20 points, or 30 points, right, as your stop loss. Obviously, the size changes, right? Because the amount of money you're risking should always stays the same, right? You hold in position for a couple days, for a couple weeks. You don't want to risk more than 2.5% of your portfolio, right? On average, that's what I propose, right? So on average account is $10,000, so 2.5% would be $250. So then you do the math, right? If you're gonna exit at below 600, then you can risk 25 shares. If you're gonna exit at 590, right, then you do 12 shares. And if you exit at 580, then you do maybe 8 shares, right? So this is how I determine position size. Obviously, it's easier said than done because you buy 10 shares, market drops below 600, you think it's going to go back to 610, and then it goes back to 590, and then at this point you're down more than $250, right? So you want to avoid the situation, right, where you are letting your stop levels get broken and still stay in the trade, right? So that's why usually I personally like to split the trade into 2, right? Because if the market drops at 600 and I'm down less than 1%, then I can think about it, right? What happened? Why did the market pull back? Will this gamma support 600 level? And will it hold, right? But if I'm down $250, it doesn't matter what the gamma says or what my opinion about the market is. I'm down $250, I have to exit. So to prevent that, you reduce your size, right? Because we're always kind of pulled in 2 different directions. One is fear of missing out, right? The train is leaving, we're making all-time highs, I'm 90% in cash, I've been in cash for the past 3 years. Okay, not good, right? So you have fear of missing out. But on the other hand, you're pulled by, and fear is one of the strongest, um, drivers from human psychology point of view. So fear of future regret. What if Trump doesn't impose 60% tariffs on China? You know, or I don't like Trump, or whatever. Half of the people don't support Trump or Trump administration. So you can say, okay, so you have a fear of future regret, right? That the world is coming to an end and inflation is gonna, get out of hand, and right. So you have these fears, and on daily basis you're pulled in different directions, right? So to deal with these fears, the only way to do this is kind of think about the market as just distribution of possible outcomes, and for every trade that you undertake, you decide, well, how much money am I willing to risk to take on this position? All right, so 1, 2, and 3. How many of you say 1? We're going 2 standard deviation to the upside. 2, no, we're range bound. We haven't really made much progress since elections, and we're just going to stay in this range. And 3, the world is coming to an end. Trump doesn't know what he's doing, and the end of the world is coming soon. 2. Anyone else? Mark. 1. Steven, Ian, Ed, David, BJ. What do you guys think? 3. Kevin, I love your consistency. You're always 3. That's great. 2. Okay. Most of you said 2. I'll agree 2. I think we're trading between 620 and 590, 580 for at least until the next earnings season. If the February, I'm only concerned about February expiration for the most part, maybe Nvidia earnings, but usually February is volatile, but March and April are considered to be more bullish time, right? So if you look from the seasonality perspective only, right? If I just look at the seasonality, let's look at our friends at bar chart. So from seasonality point of view, January, February, especially during expiration, you have to be careful. But once we're going into March, April, May, you do have average returns are positive, right? And right, March has been strong, right? 2024 strong, 23 strong, even 22 March was, and then 21, right? Even the recession. I mean, it was only negative in the COVID, right? Last time it was negative was large drawdown was during COVID, right? That sell off end of February, March. And even then, by end of March, it started recovering going into April. So March is usually a strong time of the year, right? Assuming there's no negative catalyst, right? Or event. So for that reason, I think we do make new highs. 620, I think 625 is probably the limit until the earnings starts and we have visibility in terms of, because a lot of the companies did project Q1, Q2, the revenue to be slightly lower than expected. So if that trend continues, right, and interest rates stay high, then people might be concerned about the valuations and revenue growth, right? Because the expectation that companies are going to grow, right? And the revenue is going to grow, top line and bottom line will continue to grow. So 2, any questions? So this is nice and wonderful. How do we help Tradespoon? So we have different services. I like to put it in different buckets, right? We have free education. So we have a YouTube channel, which I encourage you to participate. We have a live broadcast on Monday and Wednesday on YouTube, social media. We have different newsletters, right? So on market commentary every Monday, that 5-minute video blog, Market Briefed, is every Tuesday, and RoboStreet is every Friday, right? So you get 3 newsletters where we talk about market conditions and kind of a trade of the week, and it's free, right? This is one way to get exposure to the market and, at least our opinion on the market. We do have different webinars. So between Keith and myself, you can go and watch the recordings, live trading room recordings. You can look at the active investor workshops on any topics, right? You can type in Condor. I want to learn about Condor, or I want to learn about options. And you have, videos explaining what the condor is, or what a spread is, or what is the technical analysis, right? Head and shoulders. So a lot of free content where I encourage you to open up account at Tradespoon, right? And just type in your email. We don't collect any information. All we know is your first name and your email. That's all we know. And then you have free content, but open up an account and add info@tradespoon.com to your contacts at your email provider, right? So we don't go to spam or we don't go to promotion. So if you want to receive our email, do me a favor, just type in info@tradespoon.com so you get our emails. So this is a free education bucket. And then we have different tools and picks, right? So the model, we have AI, neural network models we've been developing for the past 20 years, these models. And there are a lot of advances in the past. The innovation is accelerating, obviously, with AI, ChatGPT. There is a lot of new models that are better for certain market conditions, are better for certain asset classes. And the AI can actually pick which model is more appropriate for which stocks or for which market conditions. So the output of these models we have on daily or weekly basis. So under active trader, these models outputted every day. Yesterday was actually a great example, Intel. It doesn't seem like nobody wants to trade Intel, but model doesn't care about the news, right, or the earnings. It just sees that something is going on in the Intel, right? This was 2 days ago. Something is going on with Intel that it moved from the 18 to 25 level, right? So the signal is generated that Intel is moving to the upside. Today, the signal was CHD, right? So it sees that market is overbought, but consumer staples, some of the consumer staples are continuing to go higher, right? CHD pull back, so maybe buying it at this current level makes sense. So you have active trader, and again, you're provided with the entry point, right? CHD is at 105, model basically says 105.15. So that was the predicted low of the session. So you can buy half of your position at 105 if you still think consumer staple is going to grind higher. And the risk is 1%, right? You exit 104.10, and model basically says that split your trade into two. So you have a strategy A, right? Usually you want to wait first 15 minutes to see where the market settles, or if you just want to buy at the open or previous close, you can also do that at 107.53. And then at this point, you would exit the position. So that's active trader. It's an output of these models, and then Keith and I trade these. We don't trade all signals, right? We're selective about our signals, but some subscribers just want signals and they have own trading plan. They already have their own execution style. They just need signals. So that's active trader. If you want to do short-term trading, weekly trader, if you want to do hold position for a little bit longer, right? The idea here is 5 to 10 trading sessions where the signal is valid. So JP Morgan, right? This Sunday, on Sunday, the model ran and gave us a signal in JP Morgan, right? And then Keith and I review these signals, and basically based on our opinion, we look at the macro, micro, dollar, we look at different parameters, we look at the position, the options data, and then, Keith might buy, Citigroup call, Vlad might buy JP Morgan vertical spread, but, the idea that banks are breaking out, right? So this is a longer period of time, and the signal was generated in JP Morgan. Then it's up to you to decide, do you want to buy it at 269 or 275, right? And the model basically suggests, for longer period of time, if you hold in position for a day, then look for 1% move, right? Have well-defined, easily achievable goals, right? JP Morgan usually doesn't move 2.5% in one day, but in a week or 2 weeks, it can move 2.5%. So this is more of a longer-term outlook. Same thing, you would split the trade into two, and your stop loss in this example is 2.5%. And if you want to trade options, right, if you want to get that leverage, then you can look at the options. But the idea is the same idea, right, that this is a long signal. Instead of buying JP Morgan stock, you can buy weekly option or monthly option, up to you. We're suggesting weekly options, 262.5 call, right? So you buy it on Monday, and then based on your trading plan, you can exit it, when you think is appropriate. But model suggests still using the levels for the stock. So, if you're buying a stock, you're looking for 2%, 2.5% move in JP Morgan, right? So it's what, $5, roughly a little bit more than $5. So if it's an option, same thing. Or if the stock moves 5% down, then it suggests to exit the price. To exit the position, whether you're doing a stock trade, option, or option spread. All right. Any questions on weekly power trader? And monthly trader, again, if you're thinking about quarters, months, then so these picks, this is the outcome of AI models, and then it's up to you to decide which of these signals you want to trade. If you want to see what I trade and what Keith trades, you can participate in live trading room, right? In Elite Circle, you can see all the trades, right? So let's look at what do we trade today. So it's a combination of both stock and options, right? So I bought AT&T was a signal in active trader model for the past couple of weeks. I bought AT&T, right, at 25.31. Again, looking for that 1% move. So I closed at 25.55, right? Was able to capture 1% in one day. And then I decided, you know what? I don't have any exposure to telecommunication. It pays dividend. Maybe people want to sell calls against it. AT&T, looks like all the bad news are factored in. It continues to grind higher, right? So I'm looking for a 2% gain on the second half of my shares. So that's an example of stock trade. And again, Keith and I going over this in morning bell and closing bell. Cisco was option trade, right? Cisco had earnings. I was bullish on the stock, so I sold a credit put spread for 17 cents, and I used that premium to finance a calendar spread, 66 call spread, right? Calendar call spread. And I was able to bought it for 19 cents, closed for 35 cents. So this is an example where you can do options where you have a limited risk, but you could have these outsized returns, right? You buying something for 20 cents and you're selling it for 35, right? So you're able to generate, 75% return in one day, 100% return day with well-defined risk, right? So options, strategies, calendars, butterflies, debit spread. This is an idea where you could have a well-defined risk. You don't have to worry about that. You cannot lose, like on call spreads, you cannot lose more than 19 cents. On put spreads, the risk is higher, right? So it's a $2 spread. This is an example of option spread strategies and earnings. Keith and I do a lot of earnings. Sometimes we do iron condors, sometimes calendars, but we're giving you different explanations of how to structure your trades, how to manage your trades. Ian, reinvest, try, get realized matter. Get out 5 weeks ago. Happy with the result. Do me a favor. We do have, if you have a positive experience, search for Trustpilot. We haven't had a review lately, but since just copy paste your your feedback here. We have 44 reviews, 4.8 stars. So if you have time, and just in general for everybody, please give us your feedback, positive feedback. If you have negative feedback, then just open up a support ticket. We'll try to address any issues you might have. But in this example, you have a very long positive feedback. Then just do me a favor and if you have time, leave it on Tradespoon side. Thank you, Ian. Yeah, 20 positions is hard, right? I mean, even Keith has a hard time dealing with 20 positions. So if you're average retail investor and you're starting out, or even if you're trading for a couple of years, I think you start with 4 positions. That's why I propose to start with 4 positions, right? on all of our kind of notes here, if you look at our imported notes, it basically says start with 4 positions and don't risk more than 2.5% account value. You do it for a couple quarters, couple months, and then if you feel comfortable, and especially if you have a larger portfolio, okay, you can grow from 4 to 8 positions. But anything above 8, 10 position, unless you're professional, money managers, it's just hard to decide. And I usually say, I think there's a famous Warren Buffett, phrase that you just have to be very skeptical, right? And of what you're buying, right? Ask yourself 10 times, why am I buying something? And what helps me a lot of time is just the fact that a lot of the stocks are correlated, right, to interest rates or to dollar, right? So, if you look at, let's say interest rate sensitive sectors today, such as small caps, right? So small caps rally, regional banks rally, right? High beta stocks rally. So if you have small banks and you have IWM might have a lot of exposure to small banks. So you want to be very careful when you buy it, and especially high beta stocks. If you buy an ARK Innovation, or you buy in Tesla, or you buy in Nvidia, I mean, they could diverge for a certain period of time. But if there is a market sell-off, usually Microsoft, Apple, Nvidia, and Palantir will sell off the same amount, right? Maybe when they rally, they diverge, but just that's something that helps me decide, in high beta stocks, I want to only have maybe one long position. So if I only have one long position, I have to ask myself, why do I want to enter a high beta stock, right? That's the most common mistake, right? Because you turn on CNBC and you hear, okay, Nvidia, Palantir, Plothin, okay, this is all great in Bitcoin, this is all great and wonderful, when the market goes up, but when the market goes down, they're all going down at very high pace, right? High multiple to the stock market. So this is something to keep in mind, right? This kind of question, that be very frugal with your money, and as limit the number of positions. Then if you only can have 4 positions, you don't want to have all 4 positions in high beta stocks, right? That would be too much of an exposure, and it's hard to deal with pullbacks. Easy buying, hard to sell. Yeah, so another thing that helps is some of the books that I would recommend. One is the prospect theory, right? Just understanding what a prospect theory, right? Studied in, if you're in finance, every program has, goes over this concept of prospect theory in behavioral economics. Basically says that you have asymmetrical relationship with gain and loss. It's exactly what you're describing, right? If you're down, $500, or you're up $500, you make completely different decisions, right? AI basically makes the same decision. You're up $500, you exit. You're down $500, you exit. But because of the $500 gain feels a lot different than $500 loss, usually if you're up $500, then you exit the position. But if you're down $500, usually you hold the position because you're hoping it's going to go back, right? And that is a very first step, is to recognize that we all have to deal with this, and then read different books. One thing that I like is Thinking Fast, Thinking Slow, right, by Daniel Kahneman. This is a great book that you can read that talks about that we have different modes of operating, right? That system 1, where we're thinking fast, and this is more of your intuition, your knee-jerk reaction, right? Or thinking slow, where this is more your frontal lobe, more methodical, more slow, right? So if you have pros and cons for both modes. So when we trade, we have these 2 decision-making process. Quick decision, market. You have a tweet from Donald Trump and you react, right? And you sell or you buy, right? Or you can start thinking slow, right? Keep a journal, look at your trading plan, how many positions you have, and you ask yourself many times why you want to get into this trade. So Thinking Fast, Thinking Slow, I think, is a great book to read if you want to kind of improve your trading results. Another one is Thinking in Small Bets. Thinking in Bets. This is actually a book for on playing poker, right? But playing poker is actually on professional level, not on gambling level, but on professional level. It's very similar to trading, right? Because you have distribution of outcomes, right? Annie Duke, she has PhD in psychology and one of the best poker players, right? Where idea that poker is not chess, right? Trading is not a chess. There is not a well-defined number of permutations that you can undertake to make a decision. So there's an emotional component, right? And there is a statistical component, right? So this is a great book to decide, look at the odds, look at the probabilities, and decide how much money you're willing to invest to support your opinion, right? So it's a great book, and I encourage you to read that as well. Current favorite, Annie Duke. Yeah, Annie Duke is, I mean, it's a great book. If you haven't read it, I mean, whether you're trading or life in general, when you make decisions, you kind of, I mean, these books come in hand. I mean, they're all similar, right? I mean, you read one, you kind of know about the other one, but it's just different perspective, and it makes you a better trader, just more, better when it comes to decision that has uncertainties, right? We're always faced with decision where there's a uncertainty. In chess, there's so many permutations, and you know what the most common openings are, right? But in trading or playing poker, there's just infinite number of these permutations. Okay, any questions so far? All right, Ian. Thoughts on Micron? Okay, let's look at Micron. So usually I look at the Micron, right, and then I looked at semiconductor, like Micron below 50-day moving average, below 200-day moving average, and it's a strong downtrend, right? Reached July high at 160 and lost half of its value, right? And then you look at semiconductors, right? In July, it reached the high of 281 and has recovered nicely. Still underperforming the market, but looks much better than Micron. So to me, the chart patterns of semiconductors looks better than the chart of Micron. So if I had purely on technical analysis, I favor, semiconductor SMH or let's say TSM, Taiwan Semiconductors. This is a strong uptrend. So if you're a trend trader, you would choose TSM over Micron. If you're a swing trader or kind of contrarian, right, you think Micron it looks so bad that it looks good, right? Or Texas Instrument is one of my positions that it looks so bad that maybe all the bad news already factored in. That's not I'm more of a momentum trader, right? I look at the models are trained not on the market neutral conditions, they're trained on momentum, right? Because it looks for stocks to outperform. So unless you have a strong opinion on the balance sheet and cash flow of Micron and their ability to invest into AI and monetize into AI, I don't have a strong opinion. I don't know if Micron or super microcomputers will be the leaders of AI. For now, it's NVIDIA, so that would be my thoughts. I mean, it's definitely oversold. I think they have earnings. When is the earnings coming up? Oh, they just had earnings. So earnings is not until 40 days. So even after NVIDIA. So a lot of it will be driven by NVIDIA, right? If NVIDIA rallies, Micron will rally too in sympathy. But if you want to know what, I guess it doesn't really matter what I think. Let's look what the market thinks. So if you look at the options data, the demand and supply for Micron, right? And the earnings is March 19th, right? So earnings is March 19th, right? So March 21st, the expected move is 10%, right? By April, it's 14. So somewhere between 10 and 14% up or down between now and the earnings. So if they hit a home run and the stock is doing well, then, it could reach 114. Let's look Micron. Let's look at the gamma exposure. Oh, I forgot to have unexpected move. So 10% up or 10% down. So and the one standard deviation move, let's see. Let's look, remove this. Micron, March 21. Yeah, so it's 110. I mean, high open interest is at 120. So I think 120, if there's a lot of positive news, then it could gravitate toward 120. And if there's negative news, 80. All right, that's all I have for today. Thank you very much and have a great day. Thank you. BJ, David, Ed, Ian, Joseph, Coffee, Michael. Thank you very much.